Thank you, team. All right, yeah, so thank you. I'm Guillaume Lambert. I'm the founder of Panoptic. And some of you may know, especially if you were here when Eric gave his talk, that equity trading happens in New York, and you have NASDAQ, Stock Exchange, IEX, happens in New Jersey. This is where most of the trading happens. And at the other side, or maybe in the Midwest, you have Chicago, where you have the CME. And the futures are traded there, options are traded there as well. There's actually a need for data to be shared between the two. So Eric talked about futures. So price moves here, the price has to be adjusted. So it's very, very direct. If you talk about options on futures now, you have an options chain that has dozens of expiries, hundreds of strikes. So not just one price to adjust, but potentially millions of data points to update in real time. And that also was a big component as to why, again, Spread Network spends hundreds of millions of dollars for creating that optical fiber highway between New Jersey and Chicago. They, again, brought the return latency to 13.3 milliseconds. Eric talked about it. I did the math about digging through the crust of the Earth to avoid the curvature. It's only 0.4%. So it's actually not going to be the right way to beat the other trading firm. As you mentioned, the limitations of fiber optics is that speed of light is slower. It's 30% slower in a fiber optic than in vacuum. So the next step, which happened very quickly after Spread Networks, was to create microwave networks that would actually go from New York to Chicago, but also follow the geodesic. So the actual curvature of the Earth has an optimal path. They can hop over Lake Michigan. They can do this in, 7.92 seconds. So this is pretty much the fastest you can get. Any trading firm or any trading activity that happens in two geographic locations is limited by this. London, Singapore, Asia, all of them have this kind of intrinsic, not block time, but latencies that exist. And that's kind of a multi-billion-dollar problem. Some people are working on it very hard. We're in a crypto conference. There is also a similar duality between AMMs like Uniswap, or it could be a CLAMM, and a derivatives protocol. Could be a perp, could be an options protocol. If it's on chain, it also has maybe some distance between the smart contract where Uniswap lives and the perp protocol, the options protocol that exists. And instead of linking a chain of microwave towers, maybe people think about how to create a transmission for the price. Maybe Chainlink. My thesis, or the thesis of our company, is that the LP side of Uniswap v3 is actually an options clearinghouse. So I'm not meaning that you can change the rules of the AMM to make it look like a covered call payoff. This is like primitive, or you can actually do this. Yes, some people have figured out this. Or it's not like maybe Lara Finance or Pods Finance that use an AMM to price the options. The actual idea behind Panoptic is that Uniswap, it's both a spot trading venue and a options clearinghouse. And this is, again, non-trivial. I'll go through several steps one by one, bite-sized pieces, and I'll start with each one. But it's a process. It took us months to figure it out. I'm sure you can do it in 25 minutes. First observation that LP positions, they have a short put payoff. So you've seen this chart several times even today. In AMM, you have X times Y equals K. With Uniswap v3, you can concentrate liquidity between a price range, and that effectively brings this curve and makes it kind of go and cross these axes. Slightly different formula. And when you do this, you have kind of it crosses zero at some point. So what that means is that the balance of that position can now be 0% of token X and 100% of token Y. So if the price is below your upper strike, it's all token X, or all token Y. If it's above the token other limit, it's all token Y. So that is kind of how you can swap between the two different token X and Y. But now it's an end state of being 100% of one or the 100% of the other. You can transform that formula to make it a bit easier to understand, where you don't look at the X and Y component that sits on a curve, but rather you look at the value of your LP position as a function of price. So x-axis is the price, y-axis is the value. And as before, if the price is above your range, your 100% token Y, in this case, could be USDC. So the price of your value doesn't change as the price of the asset goes up, so you're flat, slope of 0. If you are below that lower range, your 100% asset, 100% ETH, the price goes down, you lose 100% by each dollar that you lose. So you're a 100% slope here in one token, your 0% slope in the other token. What happens in the middle is kind of interesting. It's an interesting formula. That formula could be very different depending on the rules of the AMM. If it's not x times y is equal k, it could be something else. But as long as it's continuous, you still have kind of this smooth transition between being 100% cash and 100% asset. And that's it. If you actually start with this, and you'll see these kind of drawings, you add some liquidity to a Uniswap pool. Depending on the price, your payoff will look like 100% asset on one side, 100% cash or base on the other side. The fees you collect kind of give you some edge, some positive, I guess, value, but the final payoff is actually like a covered call or put option. And that's just kind of mathematically. The math tells you, okay, this looks very similar. And that's how I understand these positions. When I trade them, I have a max payoff and some exposure on the downside. Data point number 1. Another thing that's interesting is that these options are a bit different. So like my new best friend Chuck now has said, you need an options perspective when you look at LP positions, and you have to price them with IV, very complex. One key thing or wrench in the whole thing is that they are perpetual options. You can deposit liquidity for 25 years if the blockchain is still around. Nobody was going to force you to size you, or there's not going to be an expiry. So each of these positions are perpetual in nature, never expire. You sell a put forever. You can, of course, adjust them, and you should, but there's nothing forcing you the same way that in TradFi you have to be adjusting your put when it's, for instance, expiring. But yeah, and technically they are expiring every block and redeployed every block in a weird kind of way. But that's the put part of an LP position. If you start from there, then you can short an LP token, and that creates a long put. It's like you're buying a put option. So I'm going to go through a similar exercise. You remove some liquidity. You borrow an LP token from someone, and if the prices move, you got KDI or some stablecoin, you put the exact same amount back. No change. Some debt, you pay some interest rate maybe, and pay it back. If the price now moves down and you are below, the price is below your debt or your LP token, that debt instrument changes in competition. It was 100% USDC, now it's 100% ETH. The price is lower, you can buy ETH on the open market for lower than the strike. You can keep the difference. If you also plot this, you have a very clear long put. You buy a put for a certain price, you can exercise it if it's in the money, and this difference between the strike and the price gives you your profit, and then very, very linearly going up. And that's the other thing. You can short an LP token, get a put option payoff, and voila, you have puts and calls if you allow that shorting of LP positions to happen. Yes, some summary. The key point is that you can do this for calls as well if you borrow the asset. The put call priority comes into play, but if you borrow some ETH, put it there, you can have the same payoff as a short call, or you can borrow that ETH, you can have a long call payoff. So it's all kind of taking advantage of this unique nature of LP positions to change composition with price, where the clearing happens in Uniswap and not in a price feed manner that says, okay, the price is 5,000, you're in the money. It's really the price that's traded at that defines what the composition of that position is. And you can do multiple legs. You can buy a call, sell it at a higher price, a call debit spread. That's the payoff you get. And if you're a retail user like me, you can trade defined risk positions like an iron condor. This is 4 legs, move liquidity up. You can rethink all of these option strategies in terms of moving liquidity as opposed to buying puts and calls and kind of keeping track of everything. So that's the composability of LP positions if you allow this shorting to happen, and if you allow the shorting of the asset as well, allows you to create puts and calls, short and long, in all kind of composition. And yeah, that's the 2 first steps. Puts and calls, you can recreate this in Uniswap. This is the meatier part. So how do you price those options? And again, your best friend Chuck probably told you a bit about it. It's the fees that dictate this, but how technically do we implement this? So when you sell an option, we simply say the fees you collect is your options premium. In a weird way, you sell something and you get 0 in return. Meaning you sell something, you have nothing. The more you wait, the more swaps happen while you're in range, the more fees you collect. So your premium grows over time. It's streaming. We call this the streaming premium model. And you can hold it for, again, your 10 years. If it's out of range, you earn 0. If it's in range and you're lucky, you can earn a lot. And in that case, we say fees you collect is your options premium. This is how you get paid. Now, if you have some price move, and then it's in range, you make money, an increase in value of the premium. If you're outside, you earn nothing. So it's going to be path dependent, and you're not going to know and predict what's going to be tomorrow because the price could move. But you can actually still get some reasonable expectations of price given the size, the width of your position, and how volatile the asset is. But it's all defined on chain. We just use the Uniswap smart contracts code and quantities to assign an options premium to a put option. If you buy an option, again, you short an LP token. We also use the premium generated to price that option. Again, you buy a put option for 0, free option. There you go. And the more you wait, the more it costs you. So that's kind of the drawback. And we say that the fees collected by that position is what you get, but we add a spread term as well. It's similar to utilization curve you have in lending protocols. We want to make sure that no one comes in and buys everything. And there's no liquidity, very volatile. So we have a spread term that is added on to the fees that are generated. So I'll go over that spread term, and it helps with that type of figure. When someone sells an option, they put huge bar liquidity all the way up to the top. This is what's been sold. This is what you get as a seller. If someone else wants to buy part of that option, they remove some liquidity. So what lives in the Uniswap pool is the net. What's being deposited, big L, minus what's being purchased, small l. And if you go through the process of pricing these options, you would only collect what the net liquidity is telling you. What we say is that instead of being just the net, let me go forward a couple of slides and go back. Yes, we have some quantities. The net value is what remains. But we can actually play with the code a little bit that Uniswap has, because every time there's a swap, they increment some fee growth value. And every time you look at the swap, you assign this to either token 0 and token 1. And that grows for every swap. And when it's time to collect your position, you look at the snapshot between the current value of these growth quantities and the previous one. When you open that position, do some math, it gets you what fees you collect. And again, if you are in Uniswap, what's remaining there is what gets calculated. But again, this is all math. We can actually come in and say, oh no, let's not use that net liquidity, but rather for the buyers, it's going to be what's being purchased. What's being removed, we just swap this in. Everything, the whole equation is the same. We just say, now use this number instead of that bigger one. And that tells you how much that tiny position would earn. And that's what you give that's what the buyer pays. And as a seller, we actually look at the whole thing. Even though this liquidity wasn't there, we can also know how much was owed to them. So we use the Uniswap math, but then we substitute in any value of liquidity that we want to care about. And going back to the slide, we add an extra term to this fee that is collected and calculated. We make it explode so that if you buy 90% of the available liquidity, you pay 3 times the fees. And if you buy 50%, you pay about 25% more. So we have some built-in kind of response function as to how much you can buy and how much it's going to cost you. And again, with Eric's talk, he mentioned with Lever, you have 5 to 10% losses, perhaps, that happen. If that position is purchased at 25%, or if a quarter of it is purchased, then you make more than 10%. So you can have extra revenue sources that compensate in terms of fees by capitalizing on the fact that buyers may be willing to pay a price that's higher than the Uniswap fees. And again, we don't want to see this, but you can imagine earning 3x the fees on Uniswap if you sell at the right spot. And again, market-driven says if someone buys all the options and if the multiplier is 3x, I would come in and sell myself, get 3x the fees, make more money, and it's going to equilibrate. There's going to be a market-driven price on that. So what happens at the end is that whatever you earn as an LP in Uniswap, if there's any buying activity on top of that, you can earn more. And that's kind of an incentive to now go through Panoptic and sell options as opposed to just be an LP and provide liquidity in Uniswap. And this thing again. So yeah, so you can do simulations, and that's just to kind of make sure people understand. Sometimes you can sell an option, and if the price doesn't cooperate and goes away, you can earn 0 fees. If you've done LPing, maybe the price moved away of your range and you earned nothing. So this is actually not very good. Sometimes you earn some amount. Sometimes you're extremely lucky and stays in range, and you earn multiple times what you would have earned in the other situations. If you do this, these, again, Monte Carlo simulations, you do this hundreds of thousands of times. You can take a distribution of returns. You can extract actual an IV to that. And that IV will tell you how volatile that pool was in terms of fees and liquidity, and instead of being the realized volatility that was driven. So you can actually somewhat link this to Black-Scholes model by saying, these are the fees that I would collect by waiting 7 days. This is the price of a call option for 7 days. What's the IV? And you can solve it. And that IV could be traded. Could be the different in Deribit, CME, or some other exchange. And if it's cheap on Panoptic and rich in Deribit, you can do a natural arbitrage in that way. So pricing, very, very simply drawn off of the Uniswap smart contracts. And as I said, it's a perpetual option, but then the size of your LP position or the width has some weird property that means it has a time scale to it. And here, I'm plotting 2 curves. This in red is the Uniswap price that I showed you earlier in the value of the position as a function of price. In blue, and the reason why you can see it is that it matches very closely, is the price of a put option using Black-Scholes if it's 45 days from expiring. So in that specific case, you can take the curve that is defined by the return of your LP position, that's in this case 75% wide, which is rather wide, and say what is the closest matching put payoff that I can get from Black-Scholes that will match this payoff. In that case, it's 45 days from expiring. So there's actually a natural way to link a LP position and a option that is several days from expiring by looking at the money value. So this black line is what the option will look like at expiry, but when it's away from expiring, you can link this. So there's some algebra involved, but you can say, given a width of your position and given some type of volatility perhaps that is arbitrary, but you can take it, it gives you some type of time scale. And you can also flip between what time scale would give me certain width, what width gives me certain time scale, but at the end of it, it's all based on the fact that with Brown in motion, you don't know what the future is going to be, but you can match the width by matching the kind of growing envelope of price path that could exist. So the width of your position gives you some idea of the timeline. With just-in-time liquidity, which is single tick wide, this is similar in terms of payoff and gamma risk than an option that's 15 minutes from expiring. So 3:45 p.m. on a Friday, you trade those puts and calls if you want. That's very risky, and that's why it happens only in one block. If you're retail, you want to be maybe a bit wider. 45 days is a good timeline. You don't have to manage this every day. Weekly to monthly is kind of where people will be. But the width now guides how frequently you manage your position and how much return you'll get per day or whatever, how much you want to call it. Finally, the way that we do all of this is to start from the existing Uniswap infrastructure where some LPs come in. They currently use a non-fungible position manager that gives them an NFT and deposit into a Uniswap pool. You may have yourself had some NFTs when you did this on Uniswap. What we do is that we have we fork/replace that non-fungible position manager to create a semi-fungible position manager that's 1155. It's a slightly different way of tracking positions. And the key point is that instead of having a sequential NFT number that goes from 1 to 2 to 3, and I think in Uniswap it's like 600,000, so there's been 600,000 NFTs minted, we instead attach to the token ID, instead of being 1, it's actually a 256-bit token ID, that's a number where we bit pack a lot of different information in it. And part of it is which pool this is, and you have up to 4 legs, and each of those 4 legs has some width, some strike, some location. So we can actually use this as a message or payload where you say mint a position by supplying the token ID. That is a kind of set of instructions that will make our semi-fungible position manager to deposit, remove, do a bunch of stuff in the Uniswap pool itself. And this is the LP position part. The Panoptic protocol is a bit more complex. There's like a lending component to it. There's liquidations. We do under-collateralized lending, a lot of very, very complex stuff. But at the end of the day, the key point is that we're launching in a couple of weeks. We've been working on this for a long time. You may have heard me talk about this on Twitter forever, but now it's time. Thanks to the sponsors and the VCs and people that invest in us. And otherwise, this is the information, and thanks for the attention. I'll be happy to take any questions.
Thank you so much. Question?
Oh, no, not him. No, I'm kidding.
Yeah, are you going to have expiration, something like MEV to get you out of a position?
No, so we have to live or work with what Uniswap does. And we feel like the best way is to embrace all of this. So expiries add more complexity. There's a block that's very important. So adding and removing needs some gas operations. So yes, we make it non-expiring. There could be other ways to build on top of us, but the main layer is these perpetual options.
Okay, thanks.
Yeah.
Any other questions?
Yeah, just a small question about this fee spread. It's a multiplier, so that means if you were never in the if you never got into the range, it's still 0, right? There's no spread. Okay.
A million times 0 is 0.
Yeah,
That is 3x times 0 is 0. So yeah.
So there's no sort of constant or delta that means you always pay a little fee no matter what.
No, and I skip over some details. The way it works is that when you borrow or short any component, you pay a commission fee, which is an upfront fee. And in some weird ways, it's easier to track this way, but it's like 2 weeks worth of interest rate at 5% that you pay upfront. And if you do the just-in-time liquidity multiple times a day, you pay way more. But if you are a retail user that manages it every like 10 weeks, then you are ahead in terms of the interest rate. But yes, the adding, removing, shorting, long has this kind of fee or commission fee structure to it.
Okay, cool.
Yep.
Thanks.
I have a quick question. I was wondering the fact that you have to have like position in 2 assets rather than one kind of make it less capital efficient for the same exposure comparing to a traditional option.
No, so the way this works is that a put option that has this kind of payoff borrows USDC, swaps what it needs to, puts it in Uniswap. And when you burn it, you remove whatever's there, swap back to USDC. Mm-hmm. So you are kind of segregating the 2 markets.
Got it.
And then you can use cross-collateralization. There's a few things, but the primitive of each part is puts are stablecoin or ETH, calls are the risky asset or pay or ship or whatever you want.
If Uniswap v3 is an options clearinghouse, then also is every central limit order book, which also has offers that are on the book, is every one of those also an options clearinghouse?
So if it's the spread defines the timeline, and we've seen within 10 milliseconds you have adding and removing, it happens very quickly. The width gives you some new complexity. In that case, the gamma profile is like an AMM is always setting and putting back whenever it's filled, but here you do it over a range. So it's like maybe the clubs are milliseconds to expiry options. We can be a bit more, have some freedom, and they say, now it's a 45 days for expiry, but that's perpetually getting sold and move forward in the future by 1 block.
Have time for a few more questions? Yes.
You mentioned lending a couple times, like under collateralized lending, and then just now. Who's paying the lenders?
So the borrowers of, so yeah, so the reason why, when you create a position, you borrow capital to move into Uniswap. You can borrow more than your own collateral. You can have 1 ETH of collateral, you can borrow 2 extra ETH, and you pay a commission on that extra to everyone else that's in the Panoptic ecosystem. So you can be a passive LP, that's what we call, and yeah, I forgot that one slide. We have a two-sided kind of system where one is options trading, very active. You get money by kind of trading in a way that makes money for you. Or you can be a passive LP, which is just lending out your funds to sophisticated users, market makers, whoever is better adapted to make money work for you. They pay you an interest rate, which might be higher than what you have on Aave and Compound, but you don't have to trade and manage your position. So we have like a Panoptic trade, which is where people trade and options on meme coins and what have you. On the other side, you have Earn, which is where you deposit funds like a lending market, but it only goes to market makers, only goes to Uniswap and Panoptic. If you get liquidated, the funds never go out to buy a mansion in Australia. It's always there, so you can easily liquidate someone because of that.
Got it.
Yes, so I think we ran out of time, but last thing they
I'll be at the
yes.
happy hour, so feel free to come back.